Well, we don't let it influence our investment decision making. I think that's the first thing to understand. It's really important for us to make sure that a company like the Reject Shop, for example, is selling more $2 buckets. We're not really interested in what's happening in the Crimea because it's not going to affect how many buckets that business is going to sell. Having said that, though, I think there's a lot of fear. The market's jumping at shadows at the moment with respect to growth in China and the impact that could have on Australia. I think the market's also jumping at shadows with respect to US economic growth. I think that's steady as she goes. It's slower than everyone would like, but slow is actually a good thing because it means that the quantitative easing doesn't have to be as micromanaged as it would be if growth was speeding up. I think the risk of a disorderly unwinding of quantitative easing is more likely if growth sped up in the United States. So it's actually a good thing for markets. What we may actually see is if the growth remains slow, we might see the tapering itself be tapered, and then the markets get very excited about that. How does that relate to financial markets and particularly equities? Well, I actually think we haven't seen the third phase, which is the exuberant, euphoric stage of the stock market, so we haven't seen that yet. And so I think that the dip that we're experiencing right now, markets may fall 2%, 5%, 10%, I have no idea. But what I do believe is in the short run, it's probably a buying opportunity. And in the next 24 months, you'll see that euphoric stage, and that'll be the time to actually start liquidating and raising cash.